kind of the key to our company is that it was created by investors for investors, because we have very specific needs that most insurance guys don't understand. So we're tenured insurance guys. I've been in the business for 12 years. The company is a fourth generation company, and we went in 1999 and switched over specifically to investor relations. So we're very, very well connected in all 50 states in the real estate investing space, not just in the insurance world, but also with legislation and education. And we're very passionate about real estate investors and taking care of your needs and making sure that the insurance that you're getting on your projects, on your subject to deals, on your notes, your apartments, or your rental properties nationwide is the right insurance at the right time with fair, stable rates.
There's no way I could have done that introduction. There's no way. Okay, so the other side.
I was put on the spot, so I'll just go with it, man. They need some energy in this room.
Yeah,
you guys are putting people to sleep.
Now, you should see there's videos of this guy on the internet running through like billboards and stuff from his fitness side. He's always dressed better than I am and always in better shape than I am, so I got to give him a little bit of shit about it. So talk about
guilty.
Right. Talk about you don't have to sit in that chair if you don't want to.
I'm always standing, you're always sitting. I mean, what's going on?
Now I feel like I'm put on the spot. We got these chairs. Hold up. And then the cleat on the bottom isn't on it, so they sit really awkward. And then if you're under like 7 feet tall, they suck. So I'll stand over. So on the turnkey side, kind of give a little brief on what you've done on the turnkey side in the past.
Well, let me just get a little bit of a feel for the room. Any new investors here? Never flipped a house before?
Or own a rental or anything?
Okay, so there's a few of you brand new. Anybody that's actively flipping houses right now in Southern California? Okay. Anybody own rental properties here or anywhere in the U.S.? Okay, well, almost the same people. All right, so I started flipping houses in Ventura County. Well, actually, it was San Diego County. I started to try to flip houses in Ventura County. Couldn't get a house under contract. And this was almost 5 years ago, and I decided, I guess kind of the key that I'll give you guys that are brand new is figure out a way that you're going to add value to others, whether it's your realtors or your wholesalers or fellow investors or whatever it is, and figure out what that way is. And the way that I figured out what to do was raise money. I figured after interviewing about 100 hard money lenders, Stephen and Todd weren't around back then, that I wanted to do everything with cash. So I went out there and I decided that I was going to raise money, and if I had the money, if I had the cash, I didn't have to get financing, that was a good value that I could add to somebody else. And by the time I had raised some money, I'd raised about $500,000. I found a lady that had gotten some properties under contract in San Diego County, and I said, you know what, I'm gonna start flipping remotely. Why not? It's not working here. I'm gonna go somewhere where it's working. So she had the deals, I had the money, and then we broke into the business. Soon after that, I guess we did about 4 flips there. Then I took my money to Indianapolis because I continued to grow my network. So that's coming here just like they did, 1,000 business cards. Well, there's going to be people that are investing in other states, in other markets. Don't be secluded or confined to your market thinking that only California is going to work, or you get this depressing information about what the market is doing and no more multiple offers. Like that kind of stuff is a thing of the past around here. You got to move. You got to remain flexible and pliable with your business, and you have to have guts, because it takes guts. And I guess the way I started flipping houses 3 hours away from where I lived, I figured 5, 6 states away wouldn't make much of a difference, right? So I took the opportunity to take the money that I had and basically make it go 5 times farther in the Midwest. Started flipping houses in Indiana. Then I did a little bit of something in Georgia, and I hated it, and the people there just are very conceited.
Everybody says, like, stay away from that region.
Yeah, like realtors who want retainers before they look at a property for you, and just property managers that want the same. This is crazy stuff, right? And then it eventually ended up in Kansas City, Missouri, after I realized that flipping as I knew it when I came into the market was not the same, and it was not the future. I figured cash flow is the future. Mm-hmm. So I went from retail flips to investor flips. So now we're providing turnkey rentals. We did 168 rental properties last year, turnkey rental properties to investors. Rich Dad Organization is one of our sales funnels. We're always looking for more. But so that's kind of what I'm doing. We're still doing flips. We're still marketing. We're still getting properties. But that's my primary focus in real estate right now is the turnkey rental properties. I had gotten out of the insurance business when I decided to go full-time into real estate.
What year was that?
And, well, that was 2 years ago.
Okay.
No. Yeah, I get my days confused. Let me answer your question in reverse.
Okay.
So, when I started flipping houses, I was looking for a company that could insure my rentals or my properties the right way. I was in the business, but I knew that I didn't have access to it. I was a regular P&C guy, like most of you guys probably know. This is a regular P&C guy who wasn't an investor, didn't really understand the business. Once I got into it, I understood that I didn't have access to the right products, so I started on my quest for a couple of months until I found National Real Estate Insurance Group. I ended up meeting the owner in another networking event in San Jose. I tried to sell him on his own insurance. We became friends, and then he invested in our club, and I was on a radio show for a while. Long story short, I decided to come back into the insurance business because I'm passionate about helping my fellow real estate investors. I like real estate. Insurance is all right, but my real passion is helping my fellow real estate investors. And so now I go and I educate on the right insurance products, on the right time, the right way to structure things, and of course teach people how to invest in real estate as well.
So let's take a survey. Of the people who have flipped a house, bought a house, they had a rehab, who has had an insurance policy canceled during the construction? Todd's in the back.
He was the first one.
Ivan normally does a presentation. And I told him there's no way we're doing a presentation because I'm so sick of looking at presentations after that giant list of presentations we went to. I'm over it. And he's like super high energy. And like, I
did it in the Bay Area last week, and man, like 80 people loved it.
It's great. I'm sick of slideshows. I don't want to see them anymore. So, but everybody wants to talk about how people got in the business, what they do now, and I got a bunch of talking points I'm going to go over, like on insurance, and I kind of want to get into the turnkey stuff a little bit, and we got as much time as people will tolerate tonight.
Sure.
So, on the insurance side, as a lender, I hate a cancellation notice, and Ivan's company is the solution. I'm up here literally pointing at somebody, which I never do, and saying, this company solves a problem I have. I'm not pitching them, but honestly, they do. So, from both sides, from insurance side and from the property flipping side, let's go back a little bit farther, and let's go back to what in your brain made you decide that I'm going to flip property?
My story is relates to a certain level of pain that I was feeling in my life at the time. And because of that pain, I call it constructive discontent,
Okay.
motivated with a certain level of pain.
So dog laying a rock versus thorn through the foot.
and so I decided I need to do something else. I need to do something different. I was in the insurance business, and when I was 17 years old, I knew that I needed to get into real estate at some point in my life. I knew there was something special about real estate. I didn't know what it was. I didn't understand anything. Certainly nobody predicted 2008. But I went back to the real estate thing, and my dad, of all people, who's always been there, trying to guide me since I was a young kid, like, maybe you should do this with your life. Maybe you should do this with your life. Maybe, and always adding suggestions, and usually I'd blow them off. Well, it just so happened that he came to me with a suggestion because he knew I needed to get out of the space that I was in. And he said, you know what, I received this invitation to a real estate investing seminar. Would you come with me? And my initial reaction would be to kind of turn him down. No, I got to work. I got to be at the office, all these different things. But because of the point that I was in my life with that constructive discontent, I thought before I responded. And I said, you know what? First, I kind of had a little rebuttal. I was like, Dad, you know I don't have any money to buy houses.
And it's a scam. And I don't like this.
How am I supposed to buy houses I don't have the money? He's like, well, you know what? I hear that you could probably do it without any of your own money.
Sweet.
So I said, okay, I'll go check it out. So we went to check it out, and I ended up buying into their 3-day.
Yeah.
And then I went from there. I got upsold again. And anybody been through one of the gurus?
Right.
Okay. Anybody spend 6 figures?
Anybody spend 6 figures not going to Guru and just losing money? So I mean, Christina,
me too. So I've done both. I didn't spend 6 figures at a guru, but I have lost a lot of money in this business, and that's part of the business. And I'll proudly tell you that I've done it. I'm not going to hide anything from you because you have to understand that this is a very risky business, and you're playing at a very high level with people who are trusting you.
We're not in the kids pool.
With funds.
Yeah.
Yeah, I mean, if you try to default on Steven's loan, he's going to come after you.
Let me back up what you're saying. All right, our loan product, and this is the most regimented loan product in the business. But if you don't start construction for 2 weeks, we foreclose. If you stop construction for 2 weeks, we foreclose. If your insurance lapses, we foreclose. Don't screw up. And ours is obviously the most regimented, but we can actually physically take your property into receivership. We've never had to do it before in the past, and take over your project. We are playing at a higher level here. It doesn't make it scary. It just means know your stuff.
Yeah, so there's risk involved, just like anything else, right? And you have to tell your investors, if you're getting people to lend you money, gap funders or first trust deed investors, you have to explain to them that there are certain levels of risk involved. And you talk to a SEC attorney, they're going to tell you till they're blue in the face that you have to disclose, almost like you're trying to sell them out of investing with you. But that covers you in the back end, and it works much, much better for you.
How long is your PPM? How many pages?
I don't know.
It's like 40, 50 pages. So private placement is this memorandum you put together that describes the risk of your model. It's like 50 pages of, if you do this, burn your money.
Yeah, so we're in the process of actually doing that we've decided to take that to the next level. So we are actually creating a fund so that I got tired, let me put it this way, I got tired of selling properties to people and helping them secure their financial future. And I was working out one morning, listening to some stuff, because I always feed my mind with positive things, with educational things. And the guy was saying, focus on getting free first, then focus on getting rich. And as flippers, we're always chasing after that next deal. So we're always trying to, we're trying to get rich. And I decided, I'm selling these turnkey rentals. Well, why don't we create our own fund and hold as many of these as we want, focus on getting ourselves free first, and then sell the ones that we want. So that's what we're in the process of doing, and raising money legally now with the SEC, and it's pretty exciting. That's kind of like a level that you guys can look to get to eventually. But it never made sense until I had all the systems in place. Because part of having a fund is you got to be able to capitalize the fund.
Was that Dave Ramsey?
Dave Ramsey.
Yeah, it's like get yourself free. It's like his.
No, it was a guy, Stefan, with ProjectLifeMastery.com. You guys don't know. You guys can check that out. He's pretty awesome.
Where do I want to go with this? All right, so you go to the seminar with your dad, buy into it, flipping houses, whatever, move that way. You build. Okay, why did you decide to build a turnkey business?
Because again, I thought cash flow was the future.
So, but I mean, why not? Why at that moment was like, I'm going to build a turnkey business for other people instead of building for yourself? And not that one way is better than the other. I'm just wondering. It's
a mindset, right? It's a shift. I was already flipping houses. I understood that model. I was raising money, trusted investments, giving the money back. It's the model. It's a mindset. I didn't understand the whole concept of selling my investors on lending me money to let me hold on to it long term and then share in the rents with me. It's just like, to me, as an investor, I wouldn't do that. So it didn't make sense to me. So it wasn't until I was into the business, because the people that buy our properties usually don't have to qualify for a loan. Most of them are paying cash, right? So that's one of the issues that you run into with the retail flips. They have to qualify. They have to go through FHA. They have to go through all this first-time home buyer stuff. You don't have to do that. The amount of money invested is much less. Our average all-in, and this is going to blow you guys away if you haven't looked at rental properties in the Midwest, but our average all-in is $40,000 to $50,000. That's with renovations, and we're selling these things for $65,000 to $85,000, and $120,000 to $180,000 for the really top shelf Class A stuff, right? And in most cases, somebody gets a little bit of financing with that, but it's a lot easier for those type of people to get financing on a rental property than it is for a first-time home buyer to get through a conventional loan.
What's that buy-in cash flow typically? With that investment, what's your monthly cash flow look like?
Well, our properties sell on an average at a 10 to 30% cap rate.
Okay.
So that's the annualized
Anybody doesn't know what cap rate is? It means you're making between 10 to 30% on your money.
13.
13. Oh, I thought it was 30. I was
yeah,
like,
no, yeah.
Everybody
be lining up to buy my property.
Right, I'm like, oh my God, we pay 16% of the money.
Anybody know what the average cap rate would be in California for a rental property?
Right now, specifically? I can do it on one hand.
You're very generous.
I can do it on one hand.
Yeah, 2 to 4% if you're good. You know, you're getting 4% in California, which is fine because people are going with the appreciation game here in California, right? But that's a very dangerous game to play. You always got to buy cash flow first. Appreciation is just the kind of the butter on the bread.
Comes back with it.
Also, the renovation projects are also much shorter term, right? We're not doing these. I mean, I was doing $90,000 rehabs in Indianapolis, and something always goes wrong, something always gets delayed, so now you're into it 3, 4, 5 months before you're even ready to market. With these, our longest renovation projects take 4 weeks.
Okay. So let's go, okay, so we got through, hey, got there, what you did, what you're doing now.
I mean, I can go on.
I know we
it's
can
more
go
secured, like holding costs. Who likes holding costs while you're trying to sell your property? Sucks, right? Well, rental properties, the holding costs are taken care of by your tenants. Our average lease time by the time the thing is ready is 2 to 3 weeks. And now we pay the first months to the leasing agent, and then all of a sudden the tenant is paying for those holding costs while you're marketing the property for sale. So we don't have to worry about it. So all in all, the model just made a lot more sense to me. Once I had the systems built and in place, and I made the decision to go for it, and I started writing down my goal, and I started shifting my mindset, which, by the way, if you guys don't write down your goals, you need to start doing that.
Totally agree. So you have a turnkey process now. What was, if you can come up with 3, huge lessons in this, because I assume it's a monster of a process to put together, or like the 2, 3 major lessons you learned doing it, like just disasters or things you learned along the way?
Sure. I first tried to do something like this, well, by mistake in Indianapolis. And one of the things that I noticed or realized was a mistake was having the construction and the management not be vertically integrated and have vested interest in what you're doing. Because what ends up happening is the construction crew renovates a property a certain way, their standards, whatever it is. And property management companies have their own maintenance and renovation crews in many cases. And property management companies in many cases make as much or more money on repairs or construction than they do on management. So what ended up happening is now all of a sudden they go in there, they inspect, and they hit me up with this laundry list of things that this still needs to be done, and then we need to redo this, and we need to change out this light bulb, and we need to, you know, all these silly things. So what I ended up doing was connecting with a group and building the team that is completely vertically integrated, so that the construction company is renovating to the standards of the management company, so that that never ever happens again. And it's very much a seamless transition. And both companies, even though they're separate entities, they have a vested interest because they have mutual ownership. So that's the other thing, working with other operators or seeing how their operators work, is they will outsource their management. And so if you guys are buying properties from any kind of turnkey provider, you want to make sure that they're not outsourcing the management, because again, the management doesn't have any vested interest in that operator's product, whereas ours do.
So let's got an idea of how the turnkey process works, how you got into it, and the business. Let's kind of move our way towards the insurance side. I want to kind of talk about, well, this is a mutually beneficial thing to me. I personally want people to have good insurance on flips, so whether they're using our product or not. I have a company also insures rentals, pretty much every type of property you need, but it's designed for insuring investors.
Yeah, anything having to do with real estate investing. I won't do your personal homeowners, your autos, any of that kind of personal liability stuff, but anything investor related.
So he gave me the set of talking points because I said I didn't want to do slideshow. And the irony is I don't understand the talking points. I don't actually know enough about insurance. I just say, write the insurance policy.
Sure.
So.
Well, we can actually kind of probably
let's shrink this down.
Trim those down a little bit into a couple of different things.
Okay, so we got 13, lucky number. What do you think are the main things you want to go over that are super important?
Is anybody doing subject to deals? Done a subject to deal? Considering doing a subject to deal?
Let's talk about that, because Andy, every time it's a meeting, talks about them, and we're kind of.
You might do a subject to deal in the future. Now you'll know.
Does anybody know what a subject to deal is, or anybody not know subject to is? Is anybody willing to raise their hand? Todd's in the back. I'm going to explain subject to just because. Okay, so you're buying a property. There's a loan on the property. You leave the loan on the property in place with a whole bunch of other complicated instruments in the middle. You purchase it subject to that existing loan. Go.
Exactly. So essentially, you're entering a contract or an agreement with the seller to let you buy that property, and you essentially take over the payments, right? You relieve them of that burden, but they leave their agreement is that they're supposed to keep that mortgage in place so that you don't have to come up with a down payment, you don't have to do all these different things, because eventually what you're going to do is you're going to rent it out, you're going to resell it, whatever your exit strategy is. However, you're now taking interest in that property via contract, so you now have an insurable liability and an insurable interest in that property. So you still have to insure that interest, and you have to insure that collateral, which is basically what's securing your income or the rental income if you're going to sublease it to somebody else, right? Everybody with me? Okay, so what ends up happening is one of two things, and they're both wrong, and I'm going to explain why. So the first thing is, you're an investor, you're going to be smart, you're thinking, the insurance is an important thing, but the easiest thing to do, probably the least expensive and without disrupting anything, because God forbid somebody calls the due on sale clause, right, which almost never happens. You decide to leave the existing homeowner's policy in force and have them add you as an additional insured. Right? This is very common, very typical.
I would never do that.
Smarter people, or more educated people won't do that because they've educated themselves. There are a couple of different reasons. One, that home is no longer owner-occupied. So you have created, or there has been a substantial change in the exposure. So if there is a loss, you're giving the insurance company the right and ability to deny any kind of a claim. Big problem, because now you're tied to that property. Now, the second thing, if by some miracle the insurance company does pay out some kind of claim settlement, you're not going to get a dime of it because you're not the first named insured. So if the guy that you entered into agreement with, do you think he's going to give you any of that money? No, he's not.
He just won the lottery.
He's not, exactly. So the second scenario, second investor is a little bit more educated, decides, you know what, I got to protect my own interest. I got to have my own named insured policy. So you leave the existing homeowner's policy in place, again, because you fear the due on sale clause, but then you get your own policy against the property, and now you're the first named insured. So it's a better scenario. But here's the problem. When there's a claim, what a lot of people don't understand is that most, if not all, insurance contracts have what's called an in excess clause. What do you think that means? They're going to determine that there's two insurance policies in place, and those clauses state that we will only pay in excess of the other one. So when both of them have that in their contracts, how long do you think you're going to get stuck in arbitration and litigation, whatever it is, before any kind of settlement is paid? Okay, so the gentleman's been through some pain, and he's never going to make that mistake again. So what's the right way to do it? The way we do it is we write a commercial landlord-type policy with you as the first named insured, the homeowner or the seller as the additional insured, and the lender as the mortgagee. And in 15 years, we've never had a note call due because of that process, because the lender still sees that their borrower is still listed on that policy.
Okay, that's a nice fix. So what other ridiculously stupid insurance things have happened that you guys cover?
Okay, let's go. I'm not going to avoid your question,
no,
but I'm going to go somewhere where that I think is relevant because of the people we have in the room.
Go ahead.
So for those of you who have flipped houses, who have been to seminars, gurus, that sort of thing, who's told you that you need a builder's risk policy for
that's a good one.
Your project?
Like
Anybody? Okay, Todd's been told that. Okay, so you guys aren't getting builder's risk policies. Well, this might make the. I'm gonna tell you why you don't want that, because you will hear that. You'll hear it said on the different things, and so you say, I'm gonna need a builder's risk policy as your first flip, second flip. You go to your local agent, and you tell him, hey, I need a builder's risk policy for this property. It's vacant. It's gonna go under renovation. So he says, okay, well, let me see what I can do. So he goes and he finds a builder's risk policy for you. Gives you two options. First option is $2,000 a year.
Let's say $400 a month.
Yeah. The second option is $3,000 a year. Which one might you take?
So you're going to Lloyd's or Zurich?
Right.
Yeah, pick the two big companies that just they.
So a lot of investors might pick the $2,000 one because it's cheaper, right? And this is where we're going to educate you a little bit on some insurance terms. Because by the time it's too late and you pick that $2,000 insurance policy and then you find something better, you get to find out that that policy had 100% co-insurance or minimum earned premium. And the second policy had a 50% minimum earned premium. So what that means is that now that coverage is in force, you're stuck with that $2,000 even if you want to switch it out. Whereas the other one would have cost you $1,500. So that's a problem. And you got to understand that builder's risk is only for ground up construction. You need the right type of commercial policy with the right type of coverages, and preferably with no minimum earned premiums. So you just pay as you go, which is what we do, minimum of $1 million in liability, and the appropriate coverage for the construction. So most renovation policies will not pay in excess of the total invested capital, whereas a lot of investors try to insure for or maybe the after repair value, or they think the market value is, and they overpay. With our program, if your renovation is $50,000 and you purchase it for $100,000, you want to insure it for $150,000. And once it's done and back on the market, then you can increase it to maybe a little bit above what you paid put into it.
So another thing we see all the time on the hard money side is they just call the local State Farm agent, they get a regular insurance policy, and they say, oh, I got a rental policy and allows the property to be vacant for 30 days or 60 days or whatever. So what do you see on that side? What ends up being the loopholes on that side?
It's terrible. I've seen rental policies like as if the property was tenant occupied, issued on what we know are renovation policies.
Sure.
This was with one of my first experiences doing a joint venture with somebody, and they were handling everything. And I asked for the insurance piece, and that's exactly what they sent me. So that's one of the reasons that I decided, you know what, I need to get out and talk to people about the mistakes that they're making, because God forbid you ever need to use your insurance, but man, when you do and it's the wrong one, it can put you out of business.
I've seen like literally non-covered properties where they burnt to the ground. They just didn't cover them because insurance companies are in the business of denying your claim unless they write it for that policy.
They're not in the business of paying money. And so you got to be very careful how you structure your projects. I think you asked me a secondary question. I'm not sure if I answered.
No, that's kind of where I was going. I'm kind of thumbing through this. By the way, again, we just kind of run with this, so there's no hard format. Let's pretend it's a podcast live.
Well, what about any questions so far?
Yeah, anybody got
about
any
anything
questions?
or any issues that you're? Sure. Yeah. Sure. Okay, so let me start off with that little point, because that happens to be one of the 13 myths.
It was the one I wanted to go next. I was like the handyman on the job. Yeah. Like this is a good one.
So whatever myth number it is that hiring a handyman to do your repairs or the maintenance on your rental properties or whatever is okay. And it's really not. And the gurus do tell you these things. I mean, I've heard it in seminars before. It's like, yeah, you can shave costs on your renovations. Don't worry about how much it costs. But you want to make sure you're always working with people who are licensed, insured, bonded, preferably, and don't allow them on your site. Now, if you're using a GC and you have insurance, well, you have no liability over their subs, right? Because their subs are working for them and under their insurance, under their licenses. Make sure that you're added as an additional insured to their policy or an additional interest, and verify the insurance. It is one step that people often, if not always, miss. Verify. I can get you a certificate of insurance today, and my coverage could not be enforced tomorrow. But because you got it today and it shows an annual, it's still good for another 8 months or whatever it is, you're like, okay, you file that away. Well, on that certificate of insurance is the agent's contact information. Contact them. Ask them about it. Make sure that it is enforced. Make sure that the guy didn't call the following day or 2 days later and request a flat cancellation of that policy so he doesn't have to pay the premiums.
When you're additionally insured, will they notify you in that case?
Yes. So when you're additionally insured and there's any changes like a cancellation or a notice of a cancellation or pending cancellation, you will be notified. If you're an additional interest, additional insured, or a mortgagee, you get that notification. And if it cancels, then you would get that notification too, and you'd be like, hey, what's going on? But workers' comp. So guys working on your site, you got to make sure that the GC has workers' comp to cover whatever's happening. Otherwise, it is going to fall on you. To that end, don't ever buy materials for your contractors. Because what ends up happening is you now have created an employee-employer relationship subject to IRS taxes and also workers' comp liability. So make sure that the money goes to them. They buy the materials. You don't go to Home Depot and, I don't know. I don't think you're associated with
I was
Donruia,
actually about to attach exactly what you're saying to Jim. This is exactly why we post-fund. We fund after the repairs are finished because we don't allow money for materials up front.
Yeah. So that's something that's very crucial because I've heard a lot of people do that, and I've heard it in other RIA groups that support this. You just buy the materials. You sign up for this program. You'll get discount on materials. You go buy it for your contractor, and then we'll give you a kickback. So people are thinking they're making this kickback on these materials that they're purchasing, but they're leaving themselves wide open for not only having to pay employee taxes, but also liabilities. Okay, if the IRS finds out, which they do, it might not be you, but it will be to somebody.
And then they sue you for like unemployment and like workman's comp, just a whole mess of stuff.
It's a nightmare. So the other thing is on rehab properties, you're talking about personal lines carriers. Okay, so people like State Farm and Safeco and Allstate and farmers and all these different people that people are insuring their rental properties, and in some cases their renovation or vacant homes. These are personal lines carriers, which means that they're associated with your personal liability. So your home and your autos, that's fine. But anything that you're doing outside of that, whether you're flipping houses in your own name or own rental properties in your own name and not an LLC or some other kind of structure, you have to keep those things separate because the IRS considers anything that generates income for you a business venture or business exposure. The insurance companies, will they deny a claim potentially because they think it's a business exposure at some point? Maybe, maybe not. Not saying they won't pay a claim, but you're opening up all your personal assets to something where your majority of your liabilities are, right? You're flipping houses and your rental properties. That's where the majority of your liability is. You have to keep that separate on a commercial policy form like the one that we use. We structure the coverage on a commercial policy form. That's the basis of it. But then we custom tailor the different coverages that we want because of our buying power and our size. And we insure more than 40,000 locations nationwide right now. We've been in the business for a long time, so we have relationships with carriers that allow us to piece things together. So it's not just kind of an off-the-shelf product that we offer, but you have to do that. And any of you that have rental properties, another thing that you don't get on a personalized policy is coverage for any kind of pollutant. All those personalized policies have what's called a total or complete pollution exclusion. And one of the things that we've seen happen is a tenant could claim to get sick or injured through CO2, like emission from a heating or air conditioning source in the winter or in the summer, something like that. And God forbid, but anybody think that a tenant is capable of maybe making up a story?
Probably, yeah.
That something happened. I mean, I've seen it happen before. Something happened, they claim something happened, and the fear is not necessarily the cost to pay out a settlement if you're found guilty, but it's very likely that you don't have liability, but you still have to defend any kind of claim that's brought against you. And that's what the insurance policy is there for, unless there's an exclusion. Under our commercial policy, we offer coverage for any injuries caused by heating and air conditioning source for CO2 poisoning, which is a pollutant, which is excluded in everything else.
Is that only CO2 or is it any other pollutant?
Mainly, yeah, it's just a CO2. It's just meant for, because it's happened so much in the past where people use space heaters or they use the window units for air conditioning, or maybe
turn the oven on,
or maybe their oven, or maybe their furnace isn't ventilated properly, and CO2 emits into the house.
Okay. Makes sense. Anybody want to ask another question before I have another one? Okay, so we talked about the issue with, finger nicked on the job site, right? Mm-hmm. So now let's say you do decide for some dumb reason to hire a handyman. Now everybody in the room will say, hey, what about an umbrella policy? Can we talk about how an umbrella policy relates to either your policy or policies in general?
Sure. So there's a lot of discussion on bigger pockets and social media and different things about umbrellas. It was a big topic of discussion in the meeting I did in the Bay Area for the Real Wealth Network up there. And so an umbrella is really just an extension of your underlying liability. So figure your home and your autos are right here, and you have this umbrella that's over them. Each policy that you have, which are called your underlying policies, has a certain limit of liability. Right? An umbrella is only liability coverage. There's no property. There's nothing like that. So you have under your auto policies, hopefully, any of you that own anything have at least $500,000 in liability under your auto policy, and your home, hopefully, at least $500,000 too, because most personal lines carriers won't go above 500. They'll stop at a 500. Some of them will do $1 million. Well, say there's a claim. You're backing out of your driveway in the morning, like it happened today. Sorry, I was working out in the morning. I was jumping rope outside my front driveway, and there's a neighbor that drives like a school bus, right? And usually would be full of kids. Well, down the street, one of my other neighbors is backing up, didn't see it, T-bones it with the back of their truck, and so fortunately they were on their way to pick up kids, but God forbid that it was at a faster pace. There was kids in the car, and now you injured 3 kids.
Yeah.
Do you think $500,000 is going to be enough?
Probably not.
Probably not. In California, the most litigious state in the union, probably $1 million is not enough in many cases. So what ends up happening is you have your $500,000 in liability underlying. If the settlement is $1 million, well, now you just exhausted that $500,000, and if you have $1 million or $2 million umbrella, now the additional $500,000 comes from that umbrella. So those are your personal liabilities. Anything having to do with your home is your personal liability. Personal liability follows you anywhere in the world because you can be personally liable for anything that you do.
Sure.
You go to Germany, you get in a fight, you're going to be liable for that. You go to.
Will you tell me if I punch somebody in Germany?
I mean, I don't know why I looked at you when I said that.
Because I got kicked out of Oktoberfest in Big Bear 2 years ago,
I'm just
and I
saying
just did that immediately came to mind.
There may be
It was not my fault.
So whether you're being completely not an idiot or doing something that you're not supposed to do, you're liable for that. If you cause bodily injury to somebody else on accident or on purpose, if you cause property damage to somebody else on accident or on purpose, if somebody gets hurt on your premises, all that's your personal liability, and it follows you everywhere that you go. Same thing with your auto liability, which is separate from personal liability. You have to have your auto liability as well. The point I'm getting at is you have to keep that personal stuff separate from your business stuff. Flips and rentals are business. I don't care if you own them in your personal name. They're business. You have to keep them separate. So under our program, we have the same thing. We do $1 million liability minimum, and then we'll go in excess of $1 million up to in excess of $50 million for those who need it. And some people do. Some of our clients are people like Memphis Invest and Fortune Builders, and some of the bigger guys with a lot of rental inventory, right? Big turnkey operations. So we have layers upon layers upon layers of liability for those guys.
So let's in your policy or an umbrella policy or any policy, let's say, example, Jim's deal, he hired the guy cut his finger off on the job site. Would that be covered? Why or why not? And how could you have it covered?
No, it would not be covered because that's a workers' comp issue, and you didn't have workers' comp. If you want that covered, then you can get your own workers' comp policy, pay those exorbitant premiums, and have that covered. So or you can get the GC or whoever's running the job or the contractor himself to have his own workers' comp policy and make sure that you verify it. That's how you stop from having. Yes. Yes. Of course. Yeah, 20 rehabs, sure. Your own personal house? Sure. Yeah, no. Mhm. So let me clarify so I understand, okay? Are you talking about a rehab project or are you talking about your personal home? Are you talking about a rehab project or are you talking about your personal home?
There's a big difference between the two. That's why he's asking.
Is it your personal residence you're talking about or is it a rehab project?
Dollar amount doesn't matter.
Yeah,
Do you live in the house or are you fixing it for profit? Okay.
Okay. Yeah. Sure. Sure. So here,
But it
yeah,
makes a
and
difference.
I'm going to explain to you why that is extremely relevant to understand. Okay, and first of all, nobody said that you had to get a separate insurance policy for something having to do with your personal home, and nobody said anything about $20,000 in premium. But under your personal home owner's policy, most personal homeowners policies have what's called incidental workers' comp. And that applies to specifically people that, for example, come and you have a maid that comes and cleans your house, or you have a gardener that comes and mows your lawn every week, or you have somebody that maybe they'll come and do a couple of repairs, or maybe even paint your house and spend a couple of weeks coming to your house. So in cases like that, you have under your personal homeowner's policy an incidental workers' comp. The limitation is that in most cases, it's limited to as little as $30,000, maybe as much as $300,000, $500,000 in coverage. Now, can it exceed that? Yes. Can they deny the claim because you didn't meet their specific guideline? Because if they've worked, and every contract is different, but if they worked for you for more than X amount of hours that week or that month, and you've paid them above an X amount of dollar amount, that's going to void the coverage too. So on your personal homeowner's policy, they'll have that built into it. So you could ask your agent and say, hey, what is this incidental workers' comp coverage that's included in almost all homeowners policies do for me? What's the limit? How does that apply? When would it work? And at least find out what that looks like so that when you do decide to hire somebody, you know what risk you're taking. And to that end, yes, another one of the myths that I have on here is self-insurance is too risky, right? And that is a myth. Because as real estate investors and homeowners, we have to understand that sometimes we want to retain some of that risk. And the deductible that you choose is a form of self-insurance too, right? Some of us decide to self-insure for higher amounts, $2,000, $5,000, $10,000. And the typical general rule of thumb that I say is think about what the least or the smallest claim you would, or whatever the amount is that you would file a claim for, whatever figure that is, and then double it. So on a rehab project, if you're not going to file a claim for something that's, $2,000 thing that happens because you don't want to go through the claims process, affect your rates going forward, your eligibility, all that kind of stuff, well, double it. Carry a $5,000 deductible. Our minimum deductible is $3,000. That's the way that we structured our entire program because that's the best way to do it. And we go up from there to 5 and then to 10. But if you want to take the risk of self-insuring something, like you don't want to insure this house at all, at least insure it for liability. And we have the ability for $7 a month for a property. If you buy, you're going to do 15 projects next year. You might have 1 or 2 that sit there vacant for a little bit because maybe you picked up a pool. Even if you only own that property, maybe you're going to wholesale part of it. But if you own it for even a day or 2, just call us and say, hey, add liability for this thing for $7. Because if something happens during that period of time, you're on the hook. And they have, what, 5 or 7 years to come back, and if something happened, during that day, and it just so happens that you took ownership and you held it for that period of time, you didn't have liability coverage, man, forget about it. If you don't want to insure the property until you start it, fine, but at least do that. You're going to self-insure, and I have clients that don't insure their properties because they're self-insuring. That's a risk that they're taking, just like a risk that you would be taking. Yes, sir. Get back.
The workman's comp.
Right. You get the certificate of insurance with you listed on the certificate, then you verify that it's in force, and then you're fine. But if you're hiring a handyman or somebody without insurance, everything falls right back on you. Yes, sir.
Oh, that's a good one.
Well, in California, the base limit is $1 million. But if they go beyond that, then the insurance carrier basically still picks that up, disability, medical, they work out some kind of settlement. So I've never seen it, at least in 12 years that I've been in the business, I've never seen anything come back. And there's been some pretty bad claims where people never go back to work.
It's like my buddy of mine used to say, he's like, try and get $1 million out of an insurance company. You know anybody? Good luck.
Yeah, I've seen people get a lot more than that.
Have
I've seen him get over.
How many? So okay.
I've seen him get over $40 million. But here's the point.
Well, Larry H. Parker.
It's liability. Okay, that's the thing. People are so concerned about their property losses, right? But property losses are things that bother you and bend you. Okay, what breaks you is the liability losses. And if you don't have enough, well, how much is enough? You use that formula: bother, bend, or break. Things that bother you are going to be little But
you put them in later?
Yeah, put them in last.
Keep the appliances
after somebody's already living in the house in certain areas. But the things that bother you, right, those are the things that you retain. You don't want to pay premium for some little piddly little things, right? You retain those things. The things that bother you, maybe it's a little bit larger property loss. Maybe it's something that's going to, bend you. Maybe that's something that you think about it and you consider, well, I'm either going to transfer that or buy insurance, or I'm going to retain it. Those are still things that you can consider and make a choice. But things that break you, primarily liability stuff or the higher end property stuff, then you transfer that stuff. You don't ever want to retain the stuff that breaks you.
All right, so I think what are we getting past an hour? Anybody have any other questions? 8:35, not bad. What you got?
Sure. That's something else, and that's one of the myths. First myth of insurance for real estate investors is that insurance is exclusive of asset protection and tax planning, and that's not the case. You can't get away with one or the other, and I see posts like that all the time too. Should I get insurance or should I form an LLC?
That's a dumb
yes.
question. Yeah,
the answer is yes. Okay, is it a corp? Is it an LLC? Is it a S election pass-through? Like, I don't care. That's for you and your accountant to figure out. But you need insurance, and you need some kind of entity. Or if you're doing things in your name, if you decide to do things in your name, that's up to you too. You can do that. And some people do because they choose to, and it's part of their business plan to do so. And I don't know why they do it and whatever, but they've made that decision. But you gotta have the insurance. And the way that we structure our program too is not just the right coverage, but as real estate investors, we run into a lot of weird things that insurance companies cringe at and don't know how to handle. And you have irresponsible agents who just want to get some kind of commission writing the wrong kind of policy because you as the insured don't really understand the difference, and you're trusting them to perform their fiduciary responsibility and either give you the right coverage or tell you, you know what, I really don't think this is the right way to do it, and I'm sorry, I'm not in the business, I can't refer you to anybody else, but I can't in good conscience do this. But you don't see that. So there are things. We insure any controlling entity, whether it's an LLC, a corporation, a partnership, sole proprietorship. We insure properties for IRAs, and self-directed 401ks.
It's really important.
And those are things that a lot of insurance companies shy away from. We will insure multiple controlling entities all in one schedule. We insure all your properties under any stage of renovation or occupancy all in one simple monthly reporting form across all 50 states, so that you have a uniform renewal date, you have one point of contact, you have one relationship that you have to develop, and you don't have to wonder the next time you need to buy a property or add a project or do something else, whether that agent in this other state that you just basically found online is going to understand what it is that you need. And as your portfolio grows or the number of projects that you insure grows, and then your premium also can be reduced as well. And everything is covered under one thing. You don't ever pay more premium than what you use, because we do everything on a monthly reporting form. We can escrow premiums for 6 months or 12 months or whatever it is, but we'll never charge you. If you cancel or sell that property, you're going to get, if you used it for 6 months, you paid a year, you're going to get 6 months back. Yes, sir. So you're a trustee investor. Okay, so you would be added as a mortgagee to that insurance policy. So your borrower's project is would be insured, and then we would add you as the first lien, first mortgagee to that property. You would have the first trust deed recorded with the county and whatever. You'd have the promissory note in hand, but you would be the mortgagee. So you're actually first in line to get paid in the event of an insurance claim. Because a mortgagee is by default the additional insured and also the loss payee. You don't have to get it yourself, no, but you have to verify it. You have to make sure that it happens. Now, and another thing that we can discuss real quick that's different in our program is a little subject of co-insurance. Has anybody ever heard that term? Understand what it is? It's something that almost nobody knows about, and it's one of the things that impacts your premium and the way that your claims are paid.
I'm just like, my eyes are open up like I have no idea what he's talking about right now.
So there used to be a thing called guaranteed replacement cost that insurance companies would offer. If anybody's been in the mortgage business or done mortgage lending or anything like that, you've seen that. You've seen requests for that. Some requests still come through like that, but guess what? Hurricane Hugo and Andrew came through, wiped out the Florida and the Carolinas, and took out thousands of insured locations that were all insured on guaranteed replacement cost or a guaranteed replacement cost basis. So what do you think happened? A lot of insurance companies went under. A lot of insurance companies took a huge hit. And guess what? No more guaranteed replacement cost.
They're gone.
Because they're not going to offer that anymore. So in order to recoup costs and prevent that from happening again, they came up with a little thing called co-insurance, which means that they're going to force you to carry higher limits of liability, higher limits of property coverage based off of a Marshall and Swift replacement cost estimator that they do. And let's just say, for example, that you send them a property and they say, you know what, anybody that has a homeowner's policy, you've gone through this. The same thing applies. You send them to the location and they tell you, well, we think you should insure your property for $200,000. I know we're in California. That's not what happens here. But let's just say that for the sake of this example. So $200,000, and this company has, typically it's either 80, 90, or 100% co-insurance requirement, which means that if their replacement cost valuation is at $200,000, you have to insure for either $200,000 or 90 or 80% of that. But you as a real estate investor, you decide, you know what, I can rebuild this thing for cheaper than $180,000. I don't want to pay the extra premium for this, or the property's not worth it. So I'm going to insure it for $150,000 or $120,000. Now what you've done, because you've gone under that 80% co-insurance requirement, is you're now under-insuring, right? So you're under-insured by 30% of their co-insurance requirement. What do you think is going to happen when there's a claim settlement to be paid?
You're paying the gap?
They're hitting you with what's called a co-insurance penalty, which is going to be equal and proportionate to the level of underinsurance that you have selected.
Jim, it's like you've been sued or something.
So if you're 30% underinsured according to their requirements and their guidelines, your claim settlement is going to be reduced by 30% of the claim. Now, as a real estate investor and a homeowner, that should make you mad.
Yeah, it sucks.
We're real estate investors. We don't want that, so we don't have co-insurance requirements on our policies as long as you're insuring for a minimum of $45 a square foot. Now, you do the math and tell me if that's
so 65 is like replacement cost minimum, and like 80 really. So yeah, you're way.
Yeah, so we're way under, right? So $45 a square foot or above, there's no co-insurance requirement, which means that that rental property that you just bought, that State Farm wants you to insure for $150,000, that you bought for $55,000, and that you could probably either rebuild or walk away for cheaper than that. You want to insure it for $80,000. We'll insure it for $80,000 without any kind of penalty. And the other benefit is if you decide that that thing burns down and we pay you the $80,000, you don't want to rebuild, you want to go buy another $60,000 rental, take the cash and go buy another rental. All those other properties or companies and contracts that they have, they're going to either not give you the cash out provision, so you have to rebuild in order to get the claim. You have to rebuild or repair. Or they'll reduce that claim settlement by as much as 60% or more. You want to cash out? Sure. Here's your $80,000 loss minus 45%. Go ahead. Or you can rebuild. With us, here's your $80,000. Go do whatever you want with it.
That's my favorite part. Matter of fact, I've run into a lot of companies who buy fire properties who will look specifically for specific insurers because they know they're going to get a piece of it on the backside. That's how they buy them.
Sure. No, there is, out there in the investment world, the creative investment world outside of the stock market, you can invest into insurance companies and invest in, whether it's life insurance. I mean, you're banking for people to die, you're banking for houses to burn down, you're banking for all these different things to happen because the insurance company are in the business of making money. But we're consumers too, so that's why we structure these programs in a way that's more tilted towards us as much as we can. I mean, we're still playing against the house, right? But we have to do everything that we can to turn the odds in our favor.
Let me go. So I'm going to leave everybody with a horror story just to really kind of, because I'm sadistic and I want to end it that way. All right, so underinsured people in whatever capacity, personal, commercial, whatever. You go through a lawsuit because you didn't spend the extra $50, whatever the case may be, and you get sued. At the end of that, if you don't have enough money, it results in a judgment typically. How often, when you have somebody, let's say they have an LLC corporation, whatever, how often do you see an LLC corporation end up with a personal judgment? I don't know if you've seen these in the court side, after their insurance failed to step up.
Okay, rephrase that, the first part of that
Okay,
question.
so I have an LLC.
Yep.
So my liability is limited. I was stupid and I bridged the gap between my personal bank account and my corporate account. I pierced the corporate veil, which a lot of people do very often, especially new people. I now have I don't have enough liability. I hit a school bus, $2 million settlement. I have a $500,000 policy. Now I have $1.5 million judgment, essentially. How often do you see or have you seen corporate veils be pierced and that happens?
Do you have any vacation property in San Juan?
Nope.
No, I can't speak to the court side of that.
I don't know if you've ever seen other clients.
What I could say is that somehow if your personal liability was brought into something, then you could hope for your homeowner's policy or renter's policy to respond to it. But they're not in the business of paying claims either, so they're going to be like, well, this really originated from as a business activity, which, by the way, all personal lines policies and personal lines umbrellas have a business activities exclusion on them. So at any Yeah,
sounds about right. So anyway, get a good insurance
worse.
policy. That's all I was trying to make a point.
Yeah. Can something happen? Can a piece fall through the cracks somewhere or another? I mean, yes. Will it happen to you? Hopefully not. Has it happened to somebody? Probably. I mean, the insurance industry has evolved so much with the types of products that they offer, just, and not talking about real estate investing in particular, but just as an industry, why do you think that happens? Because all of a sudden something happened that hadn't happened before. And now the insurance industry decides, well, there's a way to capitalize on this. We'll create a product. We'll charge a ridiculous amount for it because we don't really have any underwriting guidelines and actuarials for this product, but something happened and it was pretty painful. We'll use that as an example to scare people into doing it, and then all of a sudden it becomes just kind of an industry standard. And on a regular basis, new insurance types of products come out for different types of industries and different types of things, because things do happen. So it's better to, I mean, my hope for me and for any of you is to waste every single one of your insurance dollars. Be thrown away, that you never have to go through a claims process.
Totally agree. Yeah, it's the last thing you need.
So you don't ever want to do that. You want to sleep at night, but you don't ever actually want to have to file a claim. But we're there when you do.
Awesome. Well, can I get a round of applause for Ivan? Thanks for coming out. Appreciate it.